Good morning, everybody. Welcome to the ARMR Report Week in Review. I'm Brett Rosenthal. We're going to talk about the stock market, the bond market, macro discussions of what's going on, and this unfolding bear market. So what's going to happen next is the key question we're going to try to answer, and we're going to do some connecting of the dots today. There are some very clear dots that are trying to really show us something about the market. And we're going to talk about that. So, as always, and I appreciate you spending some time here with me on a Saturday. Real quick, this is about the ARMR investing way, right? So it's right here. 3 essential stages: fundamental research, execute with algorithms, risk management rules to protect ourselves from ourselves. This is how I run my own personal capital. So the object here is to share with you the process. We call this a virtual hedge fund. Okay, this is how hedge funds execute. And as a group, a collective of individuals, we're all coming together on our trading desk and executing this strategy. And it's allowed us to dramatically outperform this year. Okay, so our balanced type of portfolios at the ARMR Report are making money this year with the market imploding. Okay, so massive amounts of alpha. We're going to walk you through how we're doing that and how we intend to continue to build on that. Okay. Of course, you've got to take your own a measure, do your own due diligence, figure out what your risk tolerance is. And then from there, you can determine how to use the information I share on Saturdays, information I share throughout the week with our free ARMR action alerts. Okay. So you can subscribe to the ARMR Report right down here in this portion of the description. You can see the subscription to the YouTube channel, but also to the ARMR Report, and you can get free updates every morning. So if you enjoy this conversation, don't forget, go ahead and share these videos with like-minded individuals who could use the help. Subscribe if you want down here. And what we're going to do now, the first thing I like to do to jump in is what I call ARMR education. So the education discussion, and by the way, when we get to the end of my opening remarks, which will be brief, wink, wink, they never are, right? It always takes me half an hour to express myself. But we're going to get to the Q&A, so don't feel shy. Make sure you fill up the comment section with questions, and we'll dive in. So what I want to do today from an ARMR education point of view is connect the dots of what's happening to the market. And it always starts with a review of the indexes, and then we go from there, okay? So just to ground ourselves, let's start with a review of the S&P. Okay, now you're going to see these lines across this screen here and names attached to it. These are ARMR Insiders, and you can see I'm right here. And we're just having fun on our live trading desk, coming up with targets of where we think the S&P can go. All right. So Miguel seems to be right now calling right here this little double bottom. But of course, Miguel, don't worry. You can change your levels at any time, okay? Saber's all the way down here, complete unwind of everything that happened after the pandemic. And I'm right in here. To me, I think the market is targeted to come down, at least to get rid of all of the Fed largesse that occurred, after the pandemic. So pandemic implosion, pandemic recovery, and then everything after that, I think, has to be wiped out, okay? But take a look at this chart right here to give you an idea of where we are in the process. This is the William O'Neill Market Smith weekly chart of the S&P. And I wanted to show you this because it just grounds where we are. Now, following the ARMR Report, if you've been on this show with me, you've been talking with me, since December of last year, the ARMR Risk Monitor has been calling for risk off. We call it Risk Monitor Red. Okay, for those of you new, we have 7 indexes designed for the 7 indexes we believe show us market direction and institutional direction. Okay, so the primary 4 are the S&P, the NASDAQ, the Dow, and the small cap. The secondary 3 are the momentum and value, either sides of that bell bar, and the IBD 50, which is an expression of innovative stocks, high growth stocks. Those 7 indexes, when they move together, what we call confluence, okay, is a clear indication that the elephants are stampeding on the Masai Mara plain, okay? And when they're stampeding in a direction, we as cheetahs want to get in front of that, want to get through their legs, don't want to get stepped on, Okay. So we look for confluence. Since December last year, we've been calling for caution. Since April 11th, that was our most recent risk-off signal. The market's been imploding, okay? But you wonder, well, where are we in the process? Is it about to rally? I still feel like a lot of people that direct message me on Twitter, and feel free to follow me on Twitter at Brett Rosenthal. I'd love to hear your comments, thoughts. I like to try to share what I'm thinking during the week. And if you have questions about it, we can communicate there. So at Brett Rosenthal on Twitter. But I still get a lot of comments. I get emails from ARMR Insiders, direct messages on our Slack desk, and it all seems to be still centered around, is the bottom here? Is this the time to buy the market? Is the market about to rally? We're still this Pavlovian dog. We're like a pack of Pavlovian dogs where we constantly think the Fed is going to come in and support the market, and that every sell-off, and this is like 20% down off the top from the S&P. So now we're in a technical bear market. Thank you very much, CNBC. It doesn't help anybody run money to call it a bear market when it's already down 20%. But, anyway, jump into our water, our pool. The water's warm. So I just wanted to show you a chart of the S&P. We're connecting dots right now. The question on the table is, are we close to a bottom? Is the market going to turn? Because that's what everyone keeps asking me. And what I want to submit to you, these are the dots. Number one, when the overwhelming amount of direct messages and emails and texts sent to me are talking about how there is no bottom and the market's collapsing, that's probably when we're going to be close to the bottom. So one of the benefits of having a lot, and I don't mean any disrespect to you all who are asking me this, it's totally a normal question. One of the beauties of building a virtual hedge fund community and all of us talking together is that we start to get we have our own social experiment going on, right? And honestly, there's nothing wrong with it. A lot of you are going to ask me right near the bottom. I think a lot of you are going to be saying to me that you think the bear market's going to get worse, right? And that's pretty much usually where the bottom ends up coming in. And I end up feeling the same way as you at that moment, by the way. I'm not some, a wizard who figures out the market's bottom. Right at that moment when it feels like things are just never going to recover is usually when the market starts recovering. So it's not even close to that yet. Okay? People are still asking about the bottom's here, the bottom's here. Let's invest. Okay? And take a look at this chart. This is a weekly chart of the S&P. The top is just now formed. There's only been a couple of weeks down from the top. So now let's go connect some more dots, okay? Let's connect some more dots. Let's zoom into the daily chart again, okay? So the selling has just started. Another question I want to address with you, and it may look at I know the question is, was that the double bottom on Friday? Okay, and what I submit to you today I have been risk off. The ARMR algorithms drive our risk decision. Okay, take a close look at our strategy. We use algorithms to execute. Okay, those algorithms, stage 2, execution strategy, day trading algos, swing trading algos for stocks, big algos on indexes. These are the things that drive our risk decision. Okay, so they've been telling us to be defensive, telling us to focus on protecting capital. That's why the ARMR report has significant alpha right now. Okay. But I hesitate to say to you all, let's get short. Shorting is not for most people. And for the majority of investors, if you want to understand how to use the ARMR report to put it to use in your approach, For the majority of investors, I will tell you all the way through the bear market not to short. Most people can't short. It's emotionally devastating when the market rips higher for a week or two, which can happen at any moment in a bear market. So please remember, everything I say today will not change if the market goes up for 2 or 3 weeks. It will not change. That will be a typical bear market rally. We may trade it on our trading desk. We may put some swing trades on. We might try to capture some upside. But what I'm going to talk to you about today, the big picture, the connecting the dots of the bear market, will not change with a 2 or 3 week rally. That will be a classic bull trap. Classic. And I want to begin laying the groundwork today so that you're not shocked by this. I want to lay the groundwork today that when we get that rally, the ARMR report will be looking to establish investing shorts. Now you say I'm too late, and I respectfully disagree. The ARMR report has a rule, right? I have ARMR rules of the road. You can find it on our website, ARMR Insiders. One of those rules is that there is a stage for investors between long and short, and it's called cash. Okay? It's for technical reasons, and it's also for emotional reasons. When you've been on the Fed gravy train for a decade, and you're smart enough to follow algorithms and risk management rules, even though your gut doesn't want to, and so you're able to protect your capital in the last 4 or 5 months so that you have massive alpha as the market's crashed. The first step there is just to do that. Just to recognize that the world has changed and go from long to cash. Okay? The next stage is short. Once you get a definable downtrend, then you can start shorting because the risk to reward sets up. The stops make sense. You have a definable downtrend. You get up to that trend, you put your shorts out. If it breaks out of the trend, you cover. Okay, not a big deal. You're close to the stop. The trend continues lower, and you can make a lot of money in a short period of time because as the bear market rumbles on, it seems to take time for a top to build, and then it starts to just crush people on the way down. Okay? And so what I submit to you is that this was a big top, and this was the place where we wanted to go from long to cash. Now the sell-off has started. I'm not going to short the initial collapse. But the rallies back to these 3 trend lines will be the places where we look to short using algorithms. I don't know if it's going to be this trend line or the 50-day moving average, which is that trend line, or the 200-day moving average, which will be that 3rd trend line. What we'll be doing is using algorithms to tell us where the short opportunities are with reasonable stops. Between now and then, there's going to be a tradable rally is usually what happens. This is a really awful bear market. There won't really be a tradable rally. The market will consolidate down here. Those trend lines will come down to it and it'll break down again. Okay, that's one scenario. We don't know if that's going to happen. But what I'm looking for is a pop higher up to these trend lines and then establishing investing shorts. Now let's go over why I'm going to do that. Let's connect the dots. This is incredibly important to me. I took the day off yesterday. Those of you who are not aware, I'm not on the trading desk with me. ARMR Insiders, you all know this. Thursday, at the end of the day, I said, you know what? Nothing's going to change the risk monitor. On Friday, I'm not going to be making any changes to the ARMR portfolios. I'm going to take the day off. I'm going to go do some fishing. All right. It was supposed to be a beautiful day for fishing. It turned out to be some pretty rotten weather, but we're having fresh mahi for dinner all weekend. So it worked, and we had a great time. Went way offshore, out into the Gulf Stream and chased the birds and had a great time. Catching mahi. But one reason I took off was I needed to clear my head a little bit. And I really wanted everybody to think about the bear market that's unfolding. And then I wanted to have this conversation with you. So let's go through a couple of key dots on this bear market, okay? Not in any particular order, so just the order that I feel like talking about it. Why don't we start with charts? Okay, you do not expect to see a total implosion in shares of Walmart. The stock doesn't trade normally like this. It doesn't normally trade from 160 down to 116 in a few weeks. These are dots to be connected. Here's Target, which is confirming what's going on at Walmart. You don't usually expect to see Target go from 254 to 149 in a couple of weeks. That's the kind of move you expect to see, okay, in ARK type of stocks. Total destruction. You don't expect to see that in an area of the market that's supposed to be safe money. This is what a bear market dot is, okay? Bear markets get to every sector. I'm going to talk about the energy stocks in a minute. But bear markets get to every sector. This is a dot of the bear market path. So a bear market starts with a major top. Then we get risk off red signals from our algorithms telling us something's wrong with the market. Then you get the breakdown. But that first topping formation, okay, you can explain it away. You could say it's overvalued growth stocks. It's a move back to valuation. Okay, you can delude yourself. And we all do it, right? With this will be a normal rotation. But today what we're doing is we're connecting the dots of a bear market. Okay? Bear markets crush everything. The proverbial baby gets thrown out with the bathwater. The best sectors go down last. I'll give you that. But they go down. Individual stock risk right now is off the chart from an ARMR investing point of view. Now, we like to put money to work when probabilities are at their highest that we're going to make money, right? Using algorithms, and rewards worth the risk. When you get conservative stocks, so you put money there because you don't expect to get destroyed and you accept a smaller upside, right? The whole idea of risk is that if you take massive risk, you get massive upside and you're willing to accept that. If you take limited risk by buying a Walmart or a Target, right? You expect limited downside, relative. Okay? When the limited downside stocks are getting slaughtered on earnings announcements. And why don't we throw in this? Throw in the Netflix chart. Okay? Because it's telling you a story. Let's look at the weekly chart of Netflix. Let's go look at the weekly chart of Netflix. This is telling you, this is a dot, okay? And this is a massive weekly top. I mean, just unwinding years of gains. You're going back to 2018. So much for long-term investing for somebody who woke up and started their 401k and bought Netflix in 2018, and they're a long-term investor because stocks always go up, right? So much for that guy because he's just wiped out all of his gains for the last couple of years, going back to 2018. Don't get me off on that rant, okay? That's why we use risk management rules here, so we don't ever get trapped like people who are trapped in Netflix. But I digress. The dots that you're looking at, Netflix, Walmart, Target, and a slew of others, okay, is a reflection of massive inflation, discretionary spending going down dramatically. These trends do not stop overnight. They're bear market trends. Let's talk about the Fed for a second. The Fed is telling you that they're raising rates aggressively and that they're behind the curve on inflation and they're going to crush the economy to get ahead of it. They're telling you that. And yet, even after the Fed comments on Tuesday, market rallied. We made money on that day trade. Market rallied because there's this Pavlovian a feeling that, okay, it's already priced in. Oh, God, it's already priced in. Those are the four most dangerous words in the stock market today. Discretionary spending is imploding. Inflation's going through the roof. The Fed's jacking up rates and is going to continue to do it. And they don't care. They understand that a stock market has to get crushed first. And that leads to real estate markets that go boom like this, right? Which leads to less consumption, which supposedly drives down inflation. Now, the problem for the Fed is that a big part of the inflation picture is war in Eastern Europe, issues in China, supply chain problems. So supply is what's jacking up. So now we're talking about 1970s. We'll get to that in a minute because that's about energy. But let's just follow the path of a bear market right now. And my point of this discussion with you this morning is to press upon you the need to protect capital. Okay? Most of you probably watching this already know that. You've already done it. Anybody new? I know it's been difficult for you. Okay? It's going to get worse. So the first thing you do to get out of a hole is to stop digging. That's step one. Stop digging. Max cash position is what we have at the ARMR portfolios. I'll go over with you in a minute what that means for a conservative approach, a balanced approach, an aggressive approach. Okay? I'll tell you what that means. How to use the ARMR report to practically use it in a portfolio. I can't tell you what to do because I don't know what type of investor you are, but I'm going to give you examples of what we would do with the ARMR report for a conservative, a balanced, and an aggressive approach. Okay? You figure out how it works for you. But this bear market, most of them last 6 to 9 months, really 9 months historically. It's just getting started. So we have to change our thought process. The tools we used in a bull market don't work now. Anybody want to argue with that? Just look at what happened this week. If you're a Spot Gamma fan, which I am, and I read, what Brent has to say, and I respect it. It's made me a lot of money over the last couple of years, okay? The theory is OPEX week, which was last week, market goes up into Friday. Volatility gets compressed. That's true in a bull market. That's true when the Fed's adding liquidity. That was wildly untrue this week. Options manipulation is too strong of a word. In a bull market with volatility compressed, options behavior can dominate real investing behavior on a weekly, intra-week basis. Okay? In a bear market where institutional investors are taking capital out of the system, they just use any options related sucker rally to dump into it. We learned that last week. That's going to repeat itself until the bear market's over. So what I'm doing on my desk is muting any strategy that worked in the bull market. You know what Einstein said, and I'm going to botch this horribly, but what he basically said was, insanity is doing the same thing over and over again and expecting different results. Okay? So you can make a couple mistakes executing a bull market strategy in a bear market and lose some money in it, We're all going to do that. But there's a moment in time at which you have to recognize that you're banging a head against the wall. You're doing the same thing over and over, expecting different results because you're executing a strategy that worked in a bull market. And if you don't recognize that, any money you made in the bull market, you're going to give it all away in the bear market. Don't believe me? Just ask Kathy Wood. So the purpose of this conversation today is to hopefully wake up awareness here. And I do these conversations for you as much for myself, okay? Because I'm still on an intraday basis, my day trading, for instance, my day trading approach, I'm still applying bull market strategies to my day trading. So I have a couple great days, then I give it all away, and I'm not getting anywhere. And I'm not getting anywhere because it's a bear market. So we need bear market strategies. And so when I look at our day trading on the live trading desk, where do we make money? It's when we employ the bear market strategy that we've employed over the last couple of months. The days where we make a lot of money on our desk, very simple execution. We get long the S&P on weakness, and we immediately put out sell stops on the NASDAQ 100 and the small cap index. Either the S&P trade makes money, great, we book a profit that day because it was a rally day, or the S&P trade gets the stop hit, we get short immediately and the market implodes and we make more money short than we lost long, right? That's our bread and butter trade. If I go look at the last 3-4 really months, those are the days we make a lot of money. Every other strategy that's connected to a bull market idea just loses money. We've got to recognize that as a collective. Okay? Let's connect more dots before I get to my 30 minutes here. Okay? So we look at Walmart. We look at Target. We look at Netflix. I want to go over to the hedge fund community now. We are seeing blow-ups, and it started with the ARK funds. It's not the ARK funds are an extension of the hedge fund community. There were a number of hedge funds that made an absolute fortune in the Fed-induced bull market. Now, take a look at the ARK funds. I don't mean to pick on Kathy, but this is what's happened. All right. The entire gains of the bull market have been erased in the ARK funds. What you've got to understand now, ladies and gentlemen, is that means hedge funds that made a fortune following innovative type of processes have been wiped out. And what we're starting to see is high-profile hedge funds going bust, closing their doors. Melvin Capital last week. Now, if you don't know Melvin Capital, they actually blew up last year because they got caught short in GameStop. Okay? So they got destroyed last year. And now they got destroyed again this year because they loaded up on big cap tech stocks to start the year. And they closed the fund last week, giving back capital to investors. You know why they do that? Just to understand hedge funds, they get paid a performance fee. When they get so in other words, they get paid when the net worth of their entire hedge fund goes above a high water mark. Then they collect 20% of the profits from there. When they lose so much that they recognize that the high water mark is so far away, they're going to have to work for free for a couple years. They close their doors. That's what happened at Melvin Capital. Melvin Capital put out some report trying to pretend that it was an altruistic thing. They were, closing their doors because they just don't get it, blah, blah, blah. But in reality, they're closing their doors because they can't get paid anymore. So what's the point? And I guarantee that guy, Gabe, is going to come out with a new hedge fund in the next 12 months, start all over again, call it something else. And when he starts from zero, he can start collecting a performance fee again. I digress. That's what the hedge fund business is. Don't hate the player, hate the game. Okay. Then we see Tiger Global down 44%. These are growth hedge funds getting blown up. What I want you to understand is, so how does this connect to the bear market? Bear markets are rolling bear markets. And one reason they roll down, you'll have brief rallies and then crushes again. It's because hedge funds are going to be going bust. Started already. It's going to accelerate. a lot of these funds have lockup agreements. So investors can't get money out except for on a quarterly basis, on a semi-annual basis, on an annual basis. And we don't know what part of the calendar these big fund blowups hit. Okay. So then what has to happen is these funds have to sell even more to raise capital to give it back to investors. We saw this happen in 2008, the financial crisis. It happens every cycle, and it exacerbates the situation. So just when you think you might be getting a bounce, you get a whole bunch of redemption requests that come in, and the market gets wrecked again. So keep your eye on what's happening. These are the dots of a bear market. Okay. Now I want to just switch over real quick to an issue I'm following closely, and then I'll get to your questions. Okay. I'm following closely the bond market. As we've been saying since last year, we've been following this chart pattern on treasuries. Okay. You guys have been with me for a while. You've seen this chart. This is TLT long-term U.S. treasuries, pre-pandemic level, Fed-induced insanity. Fed takes all that insanity out of the bond market, but inflation has gone berserk, so Fed is crushing the bond market, okay? If the bond market makes a bottom, that won't mean to me that the stock market will bottom quickly. The stock market usually follows the bond market, but with a lag. So the bond market's been getting crushed for months. Now the stock market's finally imploding. The first signs that you're 3 to 6 months away from a bear market ending will be money piling into U.S. treasuries, long bonds. Fear gauge going up. People don't know what else to do, so they start buying U.S. treasuries because they're afraid to own anything else. So it's either money market funds or U.S. treasuries. Right? So I'm watching this closely, and I'm actually looking for an entry point, maybe an allocation. Okay. So the aggressive downtrend looks like it's starting to dissipate. Maybe, who knows? I mean, it's just a small rally up to this red line, which is the third standard deviation below the 200-day moving average. That's a crazy aggressive downtrend line. But this is what I wanted to talk to you about. I'm looking for any signs of strength in here. But this is what really makes me concerned, and it's another dot of the bear market. I want you to understand the magnitude of this bear market in bonds. It's totally off the charts. You can go back, look 50 years. The speed with which rates have ripped higher from almost zero levels is mind-numbing for a bond market hedge fund, for a bond market investor. We are so far on the outside of the tail of a bell curve of expected risk. And the reason this is important is bonds are not expected to move with this type of rapidity. So in order for big fund managers to make a lot of money in the bond market, they use massive amounts of leverage. They're not taking one-to-one bets on treasuries. Okay? They're doing 10-to-1, 20-to-1. They're using huge amounts of leverage so that small volatility moves can create returns for the fund manager. There are more ugly blowups that are going to be announced. I don't know when, I don't know where, but they're out there because the bond market moving at this speed is catching a bunch of bond funds, not just treasuries. See, if treasuries are moving like this, then you go look at corporate debt, right? And so now what we have, this is junk bonds, just total implosion in junk bonds. So you got junk bond funds, which also use leverage, right? And how about corporate investment grade? Okay, this is an epic sell-off in corporate investment grade bonds. I wrote this to you guys back here when this broke down. I said this is what took down the ARK funds, the first breakdown in corporate investment grade. And when this happened here, I said to you all, guys, this is going to take down the Qs, which is exactly what's happened. It's just total implosion. It's the speed of that implosion that I want you to recognize before you start hoping and dreaming that the bear market is over. There are funds trapped, corporate investment grade bonds. I mean, somebody can challenge me, and if you think I'm wrong, I'd love for you to put it in the comments section down here and show me where I'm wrong. I don't think we've ever seen the rise in rates of corporate bonds this fast from, such a low level because it was artificially supported by the Fed. Don't forget, the Fed was buying LQD. The Fed came out the bottom of the pandemic and said, we're buying an ETF, LQD. I was shocked. I was like, what is the Fed doing buying LQD? How is that in the Fed's purview? Okay, let's don't get off on that rant. So we have artificially high levels. So then we have bond fund managers that use massive amounts of leverage to squeeze out returns on corporate bonds. And then we have one of the fastest, if not the fastest, collapses or increases in rates in history. I'm talking percentage increase, right? I'm not talking about, rates are not 10%. It's the speed from almost 0 to 3, like that exponential move. You might think, it's not a big deal. It's only 0 to 3. There are fund managers who've used massive amounts of leverage. And that small move, percentage-wise, has just blown them up. Okay. So how do we use this information at the ARMR Report to make money? And then let's get to your questions. How do we execute at the ARMR Report? Okay. I'll make this brief. It's going to be easy for you. A conservative portfolio that I manage at the ARMR Report. I manage capital, right? So I manage it different ways. A conservative portfolio is in a maximum cash position. I can't tell you what to do. I don't know your portfolio. I'm just telling you. If you say to yourself, you look in the mirror and you say, I'm a conservative investor. If you really believe that, then you're in a maximum cash position, and you have been for months. And nothing changes until the risk monitor goes green. Now's the time to go fishing on a Friday. I'm stuck to my desk in a bull market. I can't leave. I'm managing portfolios. We're making money, day trading every day. I can't get off my desk. When the risk monitor is red and the market's imploding, that's a day to go fishing. It doesn't help me to tell you that. And no one on CNBC is going to tell you that, right? Because they want your eyeballs glued to CNBC. But I'm sharing with you my experience. I'm keeping it real here, and I think integrity is more important than anything else. You don't see advertisements on the ARMR Report. You can click on this video and watch it without any of those ridiculous advertisements, right? I'm not trying to get a little bit of money from advertising. I don't care. I'm running a virtual hedge fund. I'm running my own capital. I'm trying to help investors. Okay? That's what we're doing here. So does it help me to tell you don't have to watch the ARMR Report every day? No, right? You should be clicking the buy button. You should be subscribing. You should be sharing this with everybody. And that would be great if you did, and I appreciate it. But at the moment, if you're a conservative investor, now's the time to go fishing. Okay, if you're a balanced investor, you say, okay, I want to do some things. I want to keep my finger on the pulse, which makes a lot of sense, okay? In that portfolio, we have maximum cash, but we have some dividend type investments in the portfolio. Energy pipelines, right? Exxon, Chevron, they're still in the portfolio, okay? We added Pfizer last week, all right? And in an aggressive portfolio, we're day trading every day. We have maybe a larger exposure to dividend type investments, right? And we're looking for swing trading opportunities. That's how to use the ARMR Report. Take it, make it your own, but that's how the ARMR Report's designed to help you out. I promised I'd get to energy real quick. So let me end on this note, and then we'll get to questions. I'll make this brief. Bottom line on energy. Let's take a look real quick at. Let's go look at XLE. Okay, XLE. Big cap energy stocks. Okay. I love the energy story. Energy right now represents 4.4% of the S&P 500. It was 2.4% a few months ago, so it's starting to attract capital. At the height of the 1970s bear markets, energy was 30% of the S&P 500. Okay. There's the chart. Take a look at XOP, which is U.S. E&P companies. Okay. OIH, U.S., these are service companies, not U.S., but oil service companies. Okay, these are the ETFs. I'm sharing with you the ETFs because this is my strategy going forward. This is my thought for you. I love the energy story. I think it's possible we're in a 1970s redux. So we're going to go from 4.4% to, does it have to get to 30% for us to make a fortune this year? No. What if it just doubles again to 8 or 9, 10% of the S&P? I mean, that's massive upside from here. The problem for me right now, and in my experience, is that bear markets get every sector before they're done. So it's imperative for me to do two things. Number one, I want to buy energy on weakness. I don't ever want to chase it in a bear market. So when the crescendo of selling gets so aggressive that they puke out energy stocks because we're getting margin calls or whatever, okay, I want to look to buy reversals off of that sell-off at key locations. That's where I would make my investments. The other problem is when you look at Walmart and Target and Netflix and all of these other stocks, individual stock risk is at an unbelievable high right now. I don't care what the company does. It could be Walmart, Netflix, or Peloton. Individual stocks are getting destroyed when they make an announcement that people use as a reason to sell. Okay, earnings announcements from Walmart or whatever. Okay, so my job is to get on the right side of probabilities when reward is worth risk. That's what our job is. That's what your job is. Okay, probabilities are against us when we're in a bear market buying individual stocks. Period. Don't argue that. That's a fact. Don't try to tell me that some stocks go up. You're right. Some do go up, but the probabilities are against us. It's like salmon swimming upstream, and there's a bunch of bears looking to grab the salmon and eat it. Are there going to be a couple salmon that get through? Of course they are. Okay, but I don't want to try to be that salmon. The probabilities are against us. Now the reward isn't even remotely worth the risk. If I can get wiped out in Walmart and Target, which we didn't because we didn't own them. So if somebody can get wiped out on Walmart and Target, how does the reward risk scenario make any sense to you? It doesn't make any sense to me. So if I'm going to buy energy stocks, because I love the energy story, I'm going to buy ETFs first, exchange traded funds. AMLP is my pipeline choice. OIH is my oil service choice. XLE, big cap energy choice. XOP, mid cap US E&P choice. Those are my four favorites. You say to me, that's not enough risk. I want to buy the individual names. I say to you, think about position size. I could get rid of individual stock risk by buying the ETFs. If I want more upside, I would personally rather double the position size where I still don't have individual stock risk. I would still rather do that than try to buy an individual stock in this market. And if I earn the right to take more risk, so in other words, I buy the ETFs correctly and they're making money in my portfolio. If I've earned that right to take more risk, then I might seed the portfolio with some of my favorite individual names at a later date. In other words, we get on a swing trade in the ETFs and they jump 15, 20%. Then they make a consolidation pattern. They stay above stops. And the next leg out, maybe I add individual names because maybe the market's changed. That's what I'll be doing. I hope you find that information helpful. Let's get to your Q&A. And thank you so much for listening to me for that 45-minute segment, because it really helps me organize my own thoughts so I can execute correctly Monday morning. let's jump to the Q&A. All right. Tech Monkey, how are you? Deb, what's happening? Nice to see you. Any thoughts on IIPR? Some type of legal action. All right. Well, first off, just so you all know, we don't own IIPR. Okay. We got stopped out of it at higher. So we took a position in here. And this is why we use risk management rules and stop loss techniques to protect ourselves from ourselves. So we made a lot of money on this stock. Okay. From all the way down in here, all the way up here. Then in my dividend portfolio, I sold it right up here and it came down and found support at this level. And so I gave it a shot in here. I don't know if Deb, you're still on that trade, but we gave it a shot right in here. It popped up for a couple days, comes back to break even, takes us out on a weekly level because this was a dividend portfolio position. So at the end of the week, we said, can't hold this anymore. And now it's imploding. I don't have any new information for you on IIPR. I do have a connection with management. I've had conversations with the CEO and CFO in the past. They're wonderful people. And I'm going to read up on that this weekend, Deb. And on the live trading desk next week, what I'll do is get them on the phone if I can and share it with the desk. I'll ask them some questions and see if we can't get direct answers from them. They're wonderful. They're wonderful to work with in the past. So maybe you want to drop into the comment section what the link is to that story so I can take a peek at it. And then if I feel it's necessary, I'll get on the phone with them and you all can listen into that conversation on the live desk with me. Disney, DraftKings. Okay. Disney and DraftKings, Mark. All right. Let's look at Disney. All right. So first of all, Disney, and then you have to look at Netflix. All right. Because the charts are similar. They're connected. Netflix is worse, but Disney is, the whole growth story of Disney was Disney Plus. That's really why Disney skyrocketed. Everyone's excited about Disney Plus. And of course, that whole thing is being unwound now. Bottom line, Mark, Disney is a Dow stock, right? It's a Dow S&P type of stock, and we're in a big bear market. And so this is discretionary money. I mean, think about it this way, Mark, for a second. Big picture it with me for a second. Netflix is imploding, and they've discussed how, first of all, they're firing people and they're discussing creating ads on Netflix. I mean, let's be honest, the whole point of Netflix is to avoid ads. So if they think, they must be desperate at Netflix to discuss an ad-supported part of Netflix. I mean, think about that. The whole point of Netflix is to avoid ads. And now they're going to give an ad-supported Netflix. And then this is another thought for everybody because it really affects Google and other companies, Facebook, Meta, whatever they want to call themselves. The ad market is getting ridiculously saturated. It's just ridiculous. For the longest time, Google really dominated that business. Google and Facebook, and now it seems like there's just ads on everything. Everything's going to be ad supported. Does anybody even look at ads anymore? It gets to that point where we don't even see it. So that the return on the investment from the company paying for the ads is going down. Anyway, getting back to Disney, you have record high inflation and people, can't pay for gas and basic materials. Who is going to pay for the ridiculously, inflated price of a Disney ticket? I mean, just from a fundamental point of view. So anyway, I look at Disney and there's nothing about that chart that's even remotely interesting to me. DraftKings, total unwind from the entire rally. And I've never really understood this story. I've tried to trade it a couple times. We made a little bit of money on that entry right there and we got out. The whole thing is imploded. The reason I say, Mark, I don't understand the story of DraftKings is because there's no barrier to entry. I like to invest in companies that have a moat around their business. Nobody can do what Microsoft does. Nobody can do what Apple does. Those stocks are getting crushed right now. That's different. But I'm saying big picture it. My whiteboard is full of companies that dominate a space. And DraftKings doesn't dominate anything. Don't pretend, and I don't mean any disrespect to you, Mark. I mean like the big picture. Don't pretend that they have an algorithm better that's gonna make people, bet on their platform. I mean, that's just not the case. So what happened is they were first to market, the stock went up a lot, and then everybody caught up. And now it's just a fight for eyeballs. And so the stock is imploding. So fundamentally, it doesn't make my whiteboard. Mo, how are you, man? 1.5 year S&P decline. That's an interesting piece of information that Doc is sharing with us. And, you're talking about the financial crisis of 2008, and the market dropped 55% from the top. We're only down 35% from the top in February of 2020. So there's much more to go. I'm not going to debate that with you, Mo, but you're making an assumption that we're going to have another financial crisis. So the only thing that changes in that picture, and it's a good thing you brought this up, because let me share this one fact with you about my bear market opinions. Okay, they will change on a dime if the Fed comes out and says we're no longer raising rates and we're going to start adding liquidity to the market. All right, whenever that happens, will the market be down 55% when they do that? I don't know. At some point, the pain will be enough. And I don't think the calculation right now of 35% off the high really matters to the Fed. The Fed started to stop the bull market last year. It made a big head and shoulders top, and that top just broke down. We're now down 20%. We're, according to what I read, right, the average, what is it, loss for this year or something is 20% on the S&P. So you say 35%. You read Investors Business Daily, they're marking 20% decline, whatever you want to use. The decline has just started, and the Fed is actively talking about, reducing liquidity even more. So good point, ID Doc, Mo. And the only caveat for us is when the Fed changes, we better change. You and I know you're going to be on here with me on a Saturday. The Fed's going to make their change, and you're going to be arguing with me about how the market's going to keep going down. I hope you don't do that, right? Because when the Fed changes, the market will stop going down. Even if it goes down a little bit more because people are still panicking, that'll be the time for us to be looking long. You know what I mean? So let's get our heads straight and say, yes, we think the market's going a lot lower, but when the Fed changes, we change with it, whenever that is. There still hasn't been a high volume sell-off day for anyone trying to call a bottom. Absolutely right, Jeremy. And I think there'll be a series of high volume sell-off days. Calling the bottom is total waste of time. The ARMR algorithms, in all humility, will show us windows of opportunity where probabilities are at their highest that it might be a bottom. In 2008, the risk monitor went positive 4 times and lost money 4 times. So even the risk monitor isn't going to be a guarantee the market's going up. It's just going to tell us there's a high probability at this moment that the market could go higher. So let's put some money to work. And it happened. It already happened once this year. And the risk monitor was 100% accurate. Okay? And I highlight it for you in green so you can, the color changes for you. So it went yellow to green right here, and it went higher for another week. We raised our stop to break even, and we went red right there, and then the market imploded. So we'll get another risk on green. But, I thoroughly expect one of these risk on green signals to lose money immediately, because in a bear market, that'll happen. So when we get the next risk monitor green, the only thing I'm doing is buying big indexes. And if we earn the right to take more risk because we're making some money, then we fill out the portfolio if it keeps working. But we do the big indexes first. So if it's an immediate failure, our loss is a one-day event. We go back to cash, and it's not something traumatic because we're using big indexes. I don't know what the if you went with. I know we don't bottom yet, as my average friend, visual investors are still telling me to buy the dip. Yeah, and quote Buffett saying that buy when there's blood in the street. Yeah, that really works. Buy when there's blood in the street, but he doesn't tell you how much blood. You know, is it like a bloody nose kind of blood, or is it like, a bull sacrifice in ancient Inca times? You know what I'm saying? Did you get fish? I did get fish on the boat, man. We hit a nice pocket of mahi. It was tough going. Rough seas off. We got out there. It was gorgeous. First thing in the morning, 6 a.m. left the dock. Just beautiful. I live in Palm Beach County, Jupiter area. So we went out Jupiter Inlet, and you only have to go 3 or 4 miles to hit the Gulf Stream. We were probably 20 miles offshore because we heard there was a weed line out there. And so, when you're going for particularly mahi, you find those weed lines, you troll around them, you pitch some baits out to them. But the weed line was scattered because we just got a whole bunch of thunderstorms that went, that came in. And so we were dancing with the radar between thunderstorms, looking for birds diving on water. And we caught some birds diving, and we went into that. We hit a whole bunch of mahi. But after that, the thunderstorms got so bad, we ended up having to, snake our way through some pretty gnarly weather, and then come on in. A couple bonita took some bait, and barracuda, which you can't eat those things. So we ended up coming in, but we had a great time. It was a great day, and it was a real good way to clear my head. Thanks for asking, Brett. You're so right about the almost daily gut punch of holding. Yeah. For about a month. Luckily, I have another account to buy and sell Riot, or another stock if the market rips. Okay, so you're telling me, a New York Jet fan in Florida, you're telling me that you're long triple NASDAQ shorts, and you trade against that position to try to mitigate those days where the market's up big. So if you could do that, I have unbelievable respect for you, because it's one of the hardest things to do. And so at the ARMR Report, I feel like, and as a fiduciary of capital, I feel like it's the wrong message to send and to teach, because it's so hard to do. But if you're able to do it, then have at it. And I will be taking investing shorts, but the ARMR investing way is like I said, I go from long to cash, get my mind right, and then I start shorting from an investing point of view. So we go from long in the bull market, cash during the market top, which as you can see has been happening for the last X amount of months. And then once the market starts going down, I look to short rallies to downtrends. That's how I'm going to do it. But if you can do it your way, that's impressive. You need to wear your rally cap. Geez. Yeah, the rally, the Rangers right now, they're just not getting lucky. I mean, did you see Cabo Caco in game 1 missed a gaping open net? They could have won game 1, no problem. He just, oh my God, that open net, it keeps me up at night. He must be just miserable. And then last night, they're just getting beat to the puck. It's just hard to watch, But hey, I can't believe they got past Pittsburgh. So they're a young team, and they're building for the future. And I think there's a lot of great things for the Rangers going forward. So right now, I'm just enjoying the ride and seeing how far they get. Uncle wants your 2 cents on MRO. All right. Festeroso, how are you, brother? You had me in stitches, by the way, over during the week. You sent me an email, had a really funny video. Thanks for that. Marathon Oil. Yeah, Marathon Oil. Yeah. So big cap oil with a dividend. That's where, my dividend portfolio is. I've got some Exxon, I've got some Chevron, MRO looks good. I'm not a buyer here, but that's the place to put money. I wonder what is Valero? Valero is a runaway. I can't get in there. So these things are all runaway. And in my experience, In my experience, the bear market will get bad enough and it'll drag these things down to key supports. And that's where I would look to add names. But like I said, I'm going to focus any of my additions on ETFs right now. I have a new construction loan locked at 4.8. It's for another 200 days. No worries. Mark, I can't wait to see you on the live trading desk. Don't forget, guys, if you want to subscribe both to this YouTube channel, go ahead and hit that button. But go to the ARMRReport.com, ARMRReport.com, and consider joining us on our virtual hedge fund desk. I'd love to see you there, Mark. Thanks. Zim looks good. Most tankers moving up. Yep. Zim is definitely. Don't forget, guys. For those of you who don't know Zim, they pay these one-time large dividends, and that's what that gap down is here. And so it went ex dividend there, and then it sold off, and then theoretically, after you get the sell off, it starts to march higher again into the next big dividend payment. It's right down on top of key support, and that's a small little cup and handle right there. So if I'm putting together a list for aggressive traders of individual stocks, Zim is definitely at the top of the list. And you would put your trade on here, and you would use the low of Thursday as your stop. So you'd be using the 50-day moving average really as your stop level. So the day that closed above the 50 is the low of that day is the stop on whatever move you think is about to happen here. Oh, I'm so glad you asked about MSOS. So on the ARMR Live trading desk, where I share my live screen and we talk all day, and if we cover conference calls or earnings announcements or comments and questions and answers with management teams, we just do it live so you guys can hear my questions and what the responses are. And we had that discussion this week with the CEO of Advisor Shares, Noah Hammond. And I called him because I wanted to he's a great guy, and I wanted to ask them about these comments that Morgan Stanley was revealing that they were increasing their stake in MSOS. So maybe you saw that, Deb. And after my conversation with him, and what he kind of shared with us on the live desk is that, number one, Morgan Stanley does not allow Morgan Stanley investors to buy MSOS. It's on the restricted list, just like Merrill Lynch and a bunch of other brokerage firms. But they are a custodian for hedge funds. And so in all likelihood, there's a lot of hedge funds piling into MSOS. And so it shows up on Morgan Stanley's filings that they have increased ownership, but really it's through their prime brokerage business. Why would there be hedge funds loading up on MSOS? We're not going to know the answer, Deb. But I will say that it's one of two things. The bullish opinion is somebody knows something, and we're going to get some movement somewhere in Congress that's going to be beneficial to, safe banking or whatever. That's the bullish thought process. And like I said to Noah, man, I'm dying to be bullish. He knows the ARMR Report. I've been friends with him for a while. I had a really interesting conversation with the fund manager probably two years ago, trying to understand how MSOS works. And anyway, so I've been friends with him for a while. And he knows that we haven't lost any money in the stock, right? We've made a lot of money at the ARMR Report over the last 3 years in MSOS. We've traded on the long side correctly. We've used algorithms to find entry points. We've used our risk management rules for our stops. And so, net, we've made money in cannabis. Fundamentally, it's one of my favorite stories, and it just keeps getting wrecked. And of course, the reason for that is that government is ridiculously fumbling the football on this situation. Theoretically, one day they'll get it right. When they get it right, these stocks will go to the moon. Okay. There's two ways to play that, Deb. We could stop guessing and wondering and just wait for the announcement. these stocks will be up 50 to 100% on the news. But from this level, so what? So they go up 50 to 100%. I buy it that day, and then I look to build my position over time because sky's the limit. When they change the banking rules and they're allowed to take these stocks off of the Canadian Stock Exchange and list them on the New York Stock Exchange, and institutions like Morgan Stanley and Merrill Lynch allow their investors to buy them, okay, the values are, these companies should be valued at ridiculously higher levels, but they're not because of the structure. That's the fundamental story. So we can either wait for the news to change and go buy the gap because there'll be tons of money to be made on the way up, or we could try to find an entry point early. One way to find the entry point, wink, wink, and I could do one of those, is to watch Nancy Pelosi, right? When we find out she's buying cannabis companies, maybe it's time to buy cannabis companies. We can try to guess a bottom, and for the last couple of weeks, there's a little bottom over there. Maybe they're making a bottom. But let me help you understand how MSOS works. It's a financial transaction. This is very important. Deb, anybody interested in MSOS to understand how this thing works? It's a financial transaction between advisor shares and Cowen and Company. Those two entities have come together into an agreement that the referee is Bank of New York Mellon. Bank of New York Mellon keeps the ledger. There's a basket of stocks that MSOS wants to own. Bank of New York Mellon values that basket every day. If the basket goes up, Cowen has to transfer capital from their side of the ledger over to MSOS's side of the ledger, making the net asset value. If the asset of that basket goes down, MSOS has to, or advisor shares, has to transfer capital from their side of the ledger to the other side of the ledger, to Cowen. Okay. And the referee of Bank of New York Mellon makes sure that that happens correctly. What that tells you, Deb, is that there's no guarantee that Cowen and Company owns any of the stocks. Let's take a moment to understand that. Cowen and Company does not have to own any of the stocks. It's a derivative. It's a contract. All they're on the hook for is the performance of those stocks. And they have to transfer capital over to advisor shares. Theoretically, they own the stocks to protect themselves, right? Because let's say tomorrow, safe banking's passed and the stocks are up 100%, they're going to have to transfer a whole bunch of capital over to advisor shares. And if they don't own any of the shares, that could be a big hit to them. So first of all, there's risk there. We have to hope that they honor that contract. Maybe they're making so much money right now shorting against MSOS. And when the whole thing blows up in their face, they throw their hands up and declare that I don't know what, and then there's a legal battle. I don't know. I'm just saying, Deb. I like MSOS, and I hope that won't happen. But I'm just saying that's a risk we all have to understand. So the reason I think that you're seeing Morgan Stanley and whoever's doing the business, I think that there's hedge funds recognizing the spread between reality and the NAV, right? And there's natural arbitrage going on. Shorting stocks on the Canadian Stock Exchange with impunity because it's like the Wild West up there, and there's, I don't think, any real rules on how much you can short. And getting long MSOS to protect themselves and collecting the spread. So there's a lot of shenanigans going on, and I don't think I want to be involved in that right now. It's just the wrong risk for me. Hey, Eris, how are you? Nice to see you, brother. Do you think we should watch DBC? Yeah, I do. I think the commodity index, yeah, I do. And here's wheat. Just come back down. Here's corn, and BBC is a good way to play all of that. And it could be making a high tight pennant, and that could be a place to invest. I tried to take a shot at Archer Daniels, and it went above the 50 and immediately reversed. It broke back down. So stocks may not be the way to go about it, but because the stock market is going down big, but maybe investing directly some of our capital in commodity-backed assets might be the answer for an aggressive portfolio. Instead of energy companies finding a way into UNG, which I can't right now because it looks ridiculous. I wouldn't buy that. But here's USO. Instead of buying oil companies, literally buy. Look at the pennant USO. But whatever we do there is it would be swing trading, right? Because when these things start to get crazy on the upside, they're all just derivative contracts. So I don't, I could see trading them, and that USO chart looks primed to go up and might be the better way to play energy than trying to play energy stocks that are part of indexes that are getting destroyed. So when the ETF gets destroyed, everything gets sold, no matter how good it is. But meanwhile, oil keeps going up. So maybe that is something for us to focus on. Oh, no worries, Mark. Thoughts on SBS? I don't know SBS. I'm going to have to do some research on that. The chart looks pretty good. I'm looking at MarketSmith right now for those of you curious what my trading software is. I look at MarketSmith for my research, and I use TradeStation for my trading techniques. Brazilian company supplying water to municipalities. Okay. I don't know if that really excites me, but maybe it should. I'll do some research on that. What else you got for me? Shipping stock direction. BDI. Is that a what did I just do? BDI. I don't get anything for that, so I'm not sure what that is. That you have to give me some help on that one. Pfizer. Was that the bulk? Is that the bulk index? Dry bulk shipping index? Lena, how are you? Oh, thanks for that. I try. Pfizer had a good day Friday. Oh, yeah, look at that. Oh, I didn't even see that because I was off the desk fishing. This was a new addition to the ARMR Dividend portfolio. Hey, that's beautiful. Thanks for that. I hadn't even looked at that. And let me tell you something, guys. I also added, and not for right now consumption, but I'm starting to look at mRNA and BTX again, and I've put them back on my whiteboard. They've totally wiped out the pandemic, premium. And so Pfizer's the first way to go, dividend paying stock, put it in the dividend portfolio. But at some point, the technology that BioNTech and mRNA, Moderna, that technology, is the future of vaccination. And there are many trials they're going through, many different vaccines they're going to come out with. And there is a value in what happened in the pandemic. Something that would have taken these companies probably 5 years to do from a research standpoint, they did in 5 months. So their whole business cycle, their whole business growth has been accelerated. The stocks have been destroyed because they're just pandemic puppets right now. But all of that excess is out of the stocks, and they're back down to the levels they were before the pandemic started. And yet their research and development is light years ahead. So I'm watching those stocks and I'm wondering, is that a place where I want to put capital? Not right now. It's for the whiteboard, right? Don't forget, this right here are the essential steps of the ARMR investing way. Okay. So step one is to put it on the whiteboard. Okay. There's step one, fundamental research, discussions with management, investigate the financials, something new about the company that's going to drive the business. That's what we look for. And we put it on the whiteboard. Okay. So I'm putting that on the whiteboard right now to do research and see if I want to add to these positions when we come out of this bear market. Those might be names I want to own. DBI, is that a dry bulk index? Buying Amazon. Well, first of all, think about Amazon and its connection to Target and let's be honest. At the end of the day, Jay, Target, Amazon, and Walmart all, kind of are telling the same story. And Amazon's margins are getting squeezed, and they don't have a lot of margin space. They have razor thin margins. So names that go on the ARMR whiteboard usually have fat margins where they have a moat around the business. And Amazon is stuck in inflation hell. They have razor thin margins. Their business is based on supply chains working smoothly, which is completely out the window. Their costs are going through the roof. Think of all the drivers that are driving and delivering packaging, and the price of gasoline is going through the roof. I mean, they're just getting crushed. So from a fundamental standpoint, I would ask you, Jay, why is Amazon on your whiteboard? If it is at all, why is it on your whiteboard? I'd be more than happy to hear the answer to that question. You don't have to write the comment right now, but maybe after this video, put it in the comment section. I'd love to hear your thoughts on why would Amazon be on my whiteboard? So does the MJ own their shares comparing to MSOS? Yeah, so MJ is investing in stocks that are real. I shouldn't say that. Forgive me for saying that. All the stocks are real. But what I mean is it's not a derivative. They only own stocks that trade on major exchanges. Then the last time I checked, I have to go look at MJ. I haven't looked at it in a long time. But Canopy Growth, Aurora, Hexo, or whatever they own, these things trade on the Canadian Stock Exchange, not on the these things trade on the Toronto Stock Exchange, which is like their New York Stock Exchange. It's like the big exchange. And there's all those stocks are, things could have changed, but Morgan Stanley, Merrill Lynch, whomever, they don't restrict their investors from buying Canopy Growth the last time I checked. Like these are more liquid assets that trade on bigger exchanges. Okay. The reason MSOS is a derivative is it was a work around the issue that U.S. cannabis companies are violating federal law. So you can't buy them because it's illegal theoretically. So instead, MSOS created a derivative with Cowen and Company. Advisor Shares and Cowen and got together and created a derivative, a way for us to get exposure without actually owning it. You see what I'm saying? MJ's different in that regard. Baltic Dry Index. That's what Baltic Dry Index. Yeah, that's a really good index for us to follow, Aries. I'm with you on that 100%. Do me a favor, drop in your most recent chart pattern into the ARMR Slack room so we can take a look at it. We'll use that maybe during Monday's morning meeting at 8:30. Guys, if you want to be part of the morning meeting, subscribe to the ARMR Report down here. If you want to get the morning meeting in replay, you could do that too by subscribing to our free action alerts. You get it in the morning in replay, and you can hear what we're talking about. So anyway, Aris, drop that into the Slack room, and we'll take a peek at it together. Hey, Chris, I really appreciate that, brother. Stock split. Oh, yeah. Just a long-term investment. So, Jay, you're answering the question on Amazon. Just a quick note for you. I never make an investment because of a stock split. That's actually not necessary. That's not a reason for the stock to go up just because it's splitting, just so we're all clear on that. That's a bit of a misnomer. Hang on a second. Yes, love. Yes. Okay. All right, love you. All right. Kids are at skating lessons and they're on their way home, so I'm gonna have to wrap this up soon. But just to answer your question, Jay. So I don't buy things just because they're splitting. If you're in a bull market and there is a split and it allows the stock gets cheaper and so people buy it, I understand that, but that doesn't override the bear market we're in and the horrific fundamentals of Amazon at the moment. So there will probably be a reason to buy Amazon again in the future. When the Fed changes its stance, we'll look at it. If inflation comes down, if the supply chain problems go away, I'm all with you on that. But I don't see it right now, brother. All right. Conversation with an American independent trucker. They pay per mile has fallen off the cliff. Supply of exceeds demand. I was surprised. Interesting. That surprises me. But does it really supply of truckers exceeds demand? I'm not sure I'm surprised at this point. There's been such a shortage, right, that they've attracted so many people. And now we're headed into a recession. So you're going to have an oversupply of truckers right as the recession starts. Walmart's imploding. Target's imploding. Amazon stock's imploding. We're having a recession. And so you're going to get a whole bunch of people that were attracted to trucking on the way up in an economic boom. And normally the laws of supply and demand, you end up getting too many people chasing after too few jobs right at the top. Okay. I mean, they're already in streaming, Jay. Don't forget they're Prime Video. I mean, I love Prime. I'm a Prime subscriber. I love Amazon. I love Prime Video, but so I don't think they're new to streaming. They might get a nice bump with MGM Studios, but I respect everything you're saying, Jay, and I don't want to talk you out of an investment. Hey, man, if you like Amazon, have at it. You're asking me my personal opinion. Those things don't they don't overwhelm margins that are being not just compressed, absolutely crushed, and supply chain issues. So all those things you're mentioning, like I said, in a bull market might change my mind, but they don't in this market. I think we're on the same page there. Thank you. Oh, I appreciate that, Deb. 5 years. You've been with me 5 years. I love it. Have a great weekend, Deb. And maybe we're going to end on that. Everybody have a great weekend. Deb, I appreciate those thoughts. Don't forget, guys, to do me the favor of sharing this video with friends, okay, family. Get people in here to join our virtual hedge fund community because it makes all of us stronger. And I love working with all of you. So with that, I'll bid you adieu and say have a great weekend. And I'll see all of you at 8:30 for our morning. Whoops. And there I am again, wishing you a great weekend.